So we talked about why cash flows is the single most important thing for you to understand as an investor. Cash flows are actually the secret sauce that determines the value of shares of a company. We talked about cash flow statement, how it tells what is actually going on in the company. But what I'm going to tell you is going to blow your mind. It is not the profits that actually determine the value of your company. Everyone thinks that value of a company, or let's say a price of a company, is determined on a random basis. But this is the truth. And this is how every big investor in the world thinks of a value of a company. The secret equation to value any stock in the world is not this. Its value of any share or stock in real life is equal to present value of cash flows that company will generate in its lifetime. Let me repeat it again. So in this equation, there are certain things which we are saying. First of all, present value of what? Of cash flows that company will generate in its lifetime. So what do you mean by cash flows in this equation? Like we said, there are three types of cash flows. Cash flows in operating, cash flows in investing, and cash flows in financing. So what type of cash flows are the present values we are taking that will determine the value of the company? We call them free cash flow to firms, or FCFF. We use free cash flows to the firm, or FCFF, to value any share or stock in the world. And what are free cash flows? It is just a fancy word of saying how much money is left to equity plus debt holders, that is, the suppliers of capital, after everyone else has been paid. So how do we calculate that? It's very, very simple, guys. First of all, we take operating profit after taxes. Remember the operating profit after taxes we were calculating in return on capital employed? We will take those operating profit after taxes. Then we will add depreciation. Why we are adding depreciation? Because depreciation, as you remember, is a non-cash expense. Then we will deduct capital expenditure. Remember cash flow investing activities? Now the cash flow investing activities were composed of these 6 things. Out of these 6 things, if you think about it, these 3 are not your capital expenditure. These are just a mode of saving your income. These were just operating cash flow being put in marketable securities. But this right here, payment for acquisition of property, plant and equipment, payments made with connection to business acquisitions and others, these 3 things are basically your capital expenditure. That is how much company is reinvesting back into the business, either by acquiring other businesses, that is inorganic growth, or by putting or purchasing new plant, machinery and equipment, that is organic growth. After deducting this capex, we will do plus or minus, that is depending upon how much is the changes in non-cash working capital. Remember this changes in operating assets and liabilities? So basically what we are saying is these 7 items. So the net figure of these 7 items are basically changes in non-cash working capital. Why we say non-cash? Because cash is already being adjusted in the opening balance. So whatever we are doing here, these 7 things, these are basically your non-cash working capital. Now if you look at very closely, this is a positive figure here. So if it's a positive figure, then we will take plus changes in non-cash working capital. And if it was a negative figure, that is the company was putting more amount, more cash in its stock, debtors, receivables, etc., then it would have been a negative figure. How to find it's positive or negative? Very simple. Just go to any statement of cash flow, look at changes in operating assets and liabilities, and take whatever the net amount is here. So this is your changes in non-cash working capital. Just a side note, like we said, we are adding depreciation. So what we basically mean here is we are adding non-cash expenses. So if there is these 3 expenses like share-based compensation expense, deferred income tax expense or others, these 3 will be also added back to the EBIT 1 minus tax, that is operating income. Why we are not taking net income? Because like I said, this is not free cash flow to equity. This is free cash flow to firm or free cash flow to suppliers of capital. That is for both debt and equity. Like we were calculating return on capital employed, we were taking both debt and equity. And the sneakiest way the company grow is actually through changes in non-cash working capital. This is what most of the investors ignore. Take the example of Apple. It was growing by using its working capital very effectively. And this is how the value of the company is also affected. Because if you just look at the profits of Apple was only $59 billion. But if you take into account all the other things, the profit grew from operating activities to $75 billion. So the value of any company is effectively the discounted value of free cash flows to the firm that company will earn during its entire lifetime. So let's calculate this free cash flow to firms of real world companies.